Okay, so guys, as we continue, so we're going to continue and begin talking about operating expenses. So we know, again, operating expenses are those expenditures that are used up in that period to generate revenues. We normally classify them according to functions. So, for example, general and administrative expenses are going to be kept separate from selling expenses. And there are times that all the various depreciation and R&D are treated separately. So they classify them according to the purpose. Here you see an example of the various operating expenses. When we're dealing with selling, we're going to have any shipping we do that we pay for, the advertising, sales, and marketing, all are going to be linked under selling expenses. Then the general and administrative only deals with the main admin. So any expenses as it relates to just running the company, which is separate from the sales aspect. And then in this case, they show a separate area for the depreciation. Sometimes, more often than not, I see the depreciation related to general and admin there, and then the depreciation related to selling with them. This one really breaks it out in different categories. So let's move on to, this is the real focus I want to get at, are the other operating income and expense items. Gains and losses from asset sales. This has nothing to do with the inventory. These are gains and losses from selling assets in the business. Or inventory write-downs, any impairments, restructuring charges that are a consequence of normal operating activities get included under gains and losses right before you see that operating income. So this is where we're going to have all of these unique items related to the business, but not the revenue generation. Then we've got items that are recurring, which are not directly related to primary operations that result from the financing activities of a company and the investing activities. Usually you're going to see interest, short and long-term debt, dividends, interest income and interest expense, and gains and losses of selling investments. So know this piece usually deals with the investing and financing aspect of the company, not their normal reason they're in business. And then we're going to deal with gains and losses from the non-recurring items, which would be losses, gains or loss from getting rid of debt. They're not common recurring items. They're a one-time deal. Will be put in that section. Then we end up with pre-tax income from continuing operations. That gets reported before we put into account our income tax expense. Then we'll have our income tax expense related to from the continuing operations. So as you see here, we have income from continuing operations. As you see here, income from discontinued operations, loss on disposal of equipment, and extraordinary loss. So as you see here, when you take into account all the various income tax expenses or credits, we've got a total income tax expense here of $4,050. Now, there are times, or quite often, when companies purchase an interest in another company, but they don't significantly influence the business. They have what they call a minority interest or a non-controlling interest. So this is when a parent owns a portion of a subsidiary. but it's not 100%, okay? It's not 100% owned by the parent. And basically, if, okay, let me just read here. Only arises, non-controlling interest only arises when a parent company owns a majority of the common shares but doesn't own 100%. In situations like this, the parent consolidates 100% of the subsidiary company's income statement with its own, and the non-controlling shares are entitled to a minority portion of the subsidiary's earning. We're dealing with this right now in advanced accounting. That's a little complicated for here right now. So I'm not going to worry. We're not going to learn anything about minority interest or majority interest. That's a whole nother animal that you'll capture in advanced accounting. How do income statements report discontinued operations? Basically, they're going to report the discontinued operations when anything related to that component has been eliminated, or they're not going to be significant, they're not going to have a significant interest in involvement with the company. So discontinued operations is when either it's A, been eliminated, B, it's getting ready to be sold, or C, it might still be sold, but we're not going to have an interest in the operations. This shows you the discontinued operations. We start with income from continuing operations. Then you've got an income or a loss from the discontinued section of the operations, which ultimately gives you your net income. Again, we'll go through problems. That's sometimes the best way to do it. Okay, so when a component of a company operates during part of a year and then it gets sold before the end of the year, some of it has operating income for part of the year. That has to be distinguished from the income from continuing operations for the rest of the company. So as you can see here, here's the beginning of the year, here's the end of the year. This shows when it was sold. So you've got operating income from this period of time for the entire company. And then from the date of sale to the end of the year, you're only going to show operating income from that piece that is continuing. And that will stay as continuing operations. But the portion that was sold is going to be shown as a income from discontinued operations. So just so you know, as long as the company's being sold, at that point, that's normal operations. But once that company is going to determined to be sold, then we have to separate out the portion of the company that is no longer, the income from discontinued operations will show because it's no longer going to be applicable in future years. So we want to separate it out. Let's see here. Again, I want to just focus on the items of importance. Disclosures. Let's just highlight some of the items I want you to focus on. We're not going to have any problems that relate to disclosures, but basically, in the financial statements, disclosures are almost as important as the financial statements you see. There are a lot of required disclosures, and when we're dealing with sales of companies, of a discontinued operation, they are required to disclose a lot. The description leading up to the sale, the revenues of the component being sold, the book value of all the assets and liabilities. So know that even though they're shown in the financial statements, they are still required to show in the disclosure section the detail around what was being disclosed and the breakdown of all the detail related to the assets, liabilities, the income from that discontinued operation. Now, extraordinary items are those items that are going to be reported in a separate section. Extraordinary, know this, it's an event or a transaction that is unusual and infrequent. It's unusual in nature and infrequent in occurrence. So unusual in nature means it's highly abnormal, and it's clearly unrelated to the ordinary and typical activities of the company. Infrequent, it's not reasonably expected to recur in the foreseeable future. Okay? No extraordinary, the two terms, unusual and infrequent. Okay? Biggest piece. Reporting gains and losses or losses in income. So if the event is unusual, yes, and it needs to be infrequent, then it's an extraordinary item. Let's say it's unusual, but it's not infrequent, it's not going to be an extraordinary item. It's got to show both. Okay? Will you remember that one? You're going to see it again. So basically, when we're dealing with unusual and infrequent items, extraordinary gain on the acquisition of a business, net of tax of nil. So in this particular case, it looks like what happened is they purchased a business, and in purchasing the business they showed a gain, which is like what's called a bargain purchase. So let's just say you purchase a business for $100 million. You add up all of the assets at fair market value, and they're $130 million. But you're only paying $100 million for the company. That gain, which is typically very unusual to have a gain buying a business, would be an extraordinary item. It's unusual, yeah. It's infrequent, yeah. Okay? Let's see here. So I think what I want to do, how does net income affect retained earnings? Ultimately, net income at the end of the period is going to be added to the retained earnings to begin the next period. So as you can see here in this example, we start the retained earnings at the beginning of the period. If there are any adjustments, we show that in here. We add our net income and we subtract our dividends to come up with an ending balance. Earnings per share, we're basically going to take an average of our earnings per share throughout the year, and we're going to divide we're going to take our net income that's available to common stock shareholders. Sometimes preferred stock, they're given mandatory dividends, so we'll take that piece out first. But the net income that's available to common shareholders, and then we'll do an average of shares outstanding throughout the year to come up with the earnings per share. Now, just so you know, there are all kinds of financial products that can be convertible to common stock. And so let's just say someone is dealing with some type of bond or option where they can convert it in the future to common stock. If companies have what they call dilutive securities, where even though they're not in common stock right now, the potential for them to be convertible is there, most companies will create an earnings per share based on the dilutive, encompassing any of those particular products that can be converted into stock. So they make it the most conservative view, which would include any and all items that can be converted into stock. We'll go through these. Okay, so I think we're good. Let's take a moment and start on problem 8. Okay? How are y'all doing?